Hey, Andrew, hi, everybody. This is a class that is, you're all self-selecting as masochists, because this is a class that is going to largely look at terminology around accounting and finance. And what never ceases to amaze me is how many people work in business or start companies in business, but don't understand business. It'd be like moving to Greece and not speaking Greek. It's like business is a language. Business is a language. And if you want to be able to function successfully within the environment of what is known as business, you really have to understand the language. And that language is predominantly accounting. Accounting is really, to a large extent, the language of business. It's the vocabulary, it's the terminology. And it amazes me that so many people don't realize that. And it's a handicap. And I'll say the other thing that I find that I think is probably controversial, but I think accounting is really, I think it's sexy, actually. I know that sounds ridiculous. I think it's really interesting. I think people have this idea that accountants are these, really boring people who, they work in the back room and, but I don't, when you understand accounting and its cousin finance, it's really extraordinary. The superpowers it does give you. And it opens up a lot of new worlds. So anyway, we're going to try to, within the next hour or so, run through some of the more, I think, major concepts, terms, frameworks, and so forth around the venture economics, accounting, and finance world. And I hope you find it interesting, and I hope some of it sticks. And I hope that it does enable you to basically see the world with more clarity. When people are using various terms, maybe you'll have a better understanding of what it is they're talking about, and or maybe you'll understand better that they're just bullshitting. I guess that was the introduction. So I do see accountants as superheroes. I was telling the team before we started just a few minutes ago that one of the most fascinating experiences I had at graduate school was that it was an accounting class. It was called Financial Reporting and Managerial Analysis, FIRMA, Financial Reporting and Managerial Analysis. His nickname was FIRMA, mandatory for all first-year grad students. And in one class, what they did was they showed us the identical company. Okay. Each of these companies was absolutely identical. There was no difference whatsoever between one and the other. They had identical cash flow, but they had different CFOs and they had different strategic objectives. And so one company's goal was to avoid paying taxes. And it didn't so much care about its share price at that point in time. It wanted to try and conserve its cash and not pay taxes. The other company wanted to report profit, but then it would have to pay taxes on its profit. And you could watch the way the accountants actually studied and analyzed each of these companies with identical cash flow. And one company was highly profitable. So you could open up the newspaper the next day and you'd read that it could be Apple. It could be Apple in two parallel universes. Apple Computer announced record profits. Or you could read in a parallel universe the next day, Apple Computer announces record losses. And it would be the exact same underlying condition in both companies. That's the power and the manipulation that accountants have. And when it comes to share price, Jack Welch invented this at General Electric. But he invented something called smoothing his earnings. I don't know if you ever heard that term. But the reason why he was so brilliant is he was the first one who would sit down with the CFO and the others in the company, and he would basically look ahead. So he wouldn't manage his business quarter to quarter, year to year. He would literally figure out a way to calculate and rig how he could predict his earnings so that he could go to Wall Street every single quarter. You can look this up. And he would say that General Electric today basically, advised that it will be, revenue will increase by, 12% and profit, blah, blah, blah. And he nailed it every single quarter. He always got it exactly right because he actually figured out ways through accounting to not predict it, but to make it real through the manipulation of profit, moving money from one country to another. There are ways that you can account for inventory. There's LIFO, there's FIFO. There's ways you can allocate depreciation and amortization. There's all kinds of things you can do. So accountants are superheroes. And if you don't believe me, listen to our friend
If you're going to have
Cuban.
and run a business, if you don't understand accounting, you're already behind the eight ball.
Can't you hire a guy that knows how to
But
run
then they still have to communicate to you, right? I mean, there's people that don't understand the concept of, the difference between profits and cash. Your accountant might tell you you're profitable, but your cash is going down.
Yep. Okay. That's something, right? So this will be a very basic class. I'll try to liven it up as much as I can, but so essentially we can start with what is a startup. And it's an organization that could be temporary, it could be important, where people come together to find ways to either raise money, to make money, and spend money. Essentially, that's what it is, right? If you really want to get down to it, there's only two things in business you can do. Okay. If you really want to take a look at a company, you could basically allocate almost everybody into one of two buckets. One bucket is all the people that make stuff, and one bucket is all the people that sell stuff. And a startup is essentially about making things and selling them, and making things that you can sell for more money than it costs you to make. That's really it. There's a term, startup versus small to medium-sized business. You hear SMB, you hear SME, small to medium-sized enterprise, SMB, small to medium-sized business, startup. There's not a clear line, but startups are usually considered smaller, scalable, faster. But some people, consider Anthropic and OpenAI startups, right? Which they're huge startups. I mean, OpenAI has 5,000 people, I think. It's always the same. The life cycle is always the same. There's an idea. That idea has to be basically extracted or mined out of a human imagination. And the only way you can mine that and extract that idea out of a human imagination is through the articulation of a narrative or a story. which is why storytelling is incredibly powerful. Because without the ability to tell a story about your idea, you're not going to be able to start a company. Nobody's going to care about what you're doing. Nobody's going to join you. Nobody's going to invest in you. Nobody's going to buy anything you make or sell. You get that product validated. There's something called product market fit. I'm sure you've all heard of PMF, growth scaling. And an exit is a term used by mostly investors and entrepreneurs. People like to brag about their exits, meaning that they were able to sell their company for a certain amount of money. That's what an exit is. There's two ways of exiting. There's what's called the divestiture or the sale, which means you sell your company to someone else and they pay you for your company. And that takes all of your stock and your ownership and monetizes it, and you create liquidity. The other is you sell it to the public, which is an IPO. Klarna just went public yesterday. They're both sales. One is a sale of your stock to the public. The other is a sale of your stock to a company. The valley of death is really an interesting term that is important. Curious your AI faced it. That, in fact, a couple of my investors about a year and a half ago basically just said, why don't you just wrap this up, Stephen? We love you. A wipeout. They called it a wipeout. A wipeout is never a great thing, but maybe it's time to just unwind because you're in the valley of death. And that's when they don't want to invest in you anymore. And they basically leave you for dead. The valley of death is usually a point where you've been able to build a product, but you don't have the distribution. And most people don't realize distribution is as important, if not more important, than the product. Distribution wins in the end. Walmart, Amazon, they don't make anything. They're distributors. So the valley of death is all of a sudden you wake up one day and you've got an MVP of a product, Alice, and you have no money to find anybody to buy it. like how are you going to build a marketplace? And that's the valley of death. It's a very, 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 very difficult place to survive. If you're fortunate enough, maybe you have enough money that you can buy distribution. Distribution almost always costs money. A runway is how much basic time a company has to live. Most startups lose money and they burn a certain amount of money every month. And it's a really simple calculation. If you've got $100 in the bank account and you're burning $10 a month, you got 10 months of runway, right? It's pretty simple. It's a critical metric for businesses to understand and for startups to understand. The burn rate is the amount of money you're spending on an ongoing basis. It's usually monthly net cash outflow. It's your oxygen. How much money are you spending? And what happens? How long can you go before you run out? There's a thing called valuation. Pre-money versus post-money. The way that works is that, let's say you've started a company and there's two of you. And so you each own half the company. We'll talk about a cap table in a minute, but let's just say you decide to carve up the equity in the company. And there's a cap table and your name and your co-founder's name is on the cap table because you started the company together and you each have 50%. And some investor comes in and says, I like what you guys are doing. I'm going to give you $10 million for 10% of your company. So now you each own half the company, right? And that investor comes in and says, I'm going to give you 10 million for 10%. Okay. So what happens at that point is your pre-money is 10 million because you're giving you 10 million for the company. But your post money is you're worth 100 million post because now they paid 10 million for 10%, which is 100% would be 100 million. That's the difference between pre-money and post-money. And that happens all the time in startups. There's this thing, have you all heard about economies of scale and economies of scope? People use the terms interchangeably. It's really important when you're starting a company to understand what your economies of scale and scope are, because it is your basic economics. Economies of scale are basically the more you make of something, the cheaper it is on a per unit basis, right? So let's say you're printing a book and you've got to set the printing press up, right? So it's going to cost you $100,000 to set the printing press up, the setup cost of $100,000. But you're only going to print one book. That book's going to cost you $100,000. But if you print 100 books, it's less per book. 1,000 books, it's less per book. Theoretically, to infinity, it goes down to 0 per unit. But that's economies of scale, okay? The more of something you do, the cheaper it is on a per unit basis to do it, which means you can make more money on a per unit basis to do it. Economies of scope are really cool, and it tends to get confused with economies of scale. The way I see economies of scope is I think about it in terms of a truck. And you own a truck. And somebody pays you to carry a package across the United States. They give you $100 so that you can drive their package in your truck from San Francisco to Philadelphia. Now, you got to drive that truck. You got to pay the fuel. You got to pay whatever it costs you on the lease. You've got all these costs, and you got one box in that truck, and you get paid $100. But if you have 2 boxes, you could get paid $200. 3 boxes, $300. 4 boxes, $400. If you fill up the truck, you can make maybe $1,000. Costs you the same amount. Takes you the same amount of time. It's the same truck. It's the same lease. It's the same fuel. That's economies of scope. Extremely, extremely powerful. Operating leverage is related to economies of scale. A lot of times a business will say, we've got enormous operating leverage. That's a really good thing, because that means with just a little bit more, you can make a lot more. The problem is if you lose a little bit, you lose a lot. It's leverage. Planes, hotels, drugs, movies, these are great industries to think about operating leverage. It's similar to scope. So the airline business has enormous operating leverage, right? It costs them a certain amount to fly their planes, whether there's 1 person in it or 300 people in it. Theoretically, if there's 1 person in a plane and they can fit 300 and they take 299 of their empty seats and charge each of those 299 individuals $1, it's a net plus for them. They don't do that for reasons, but that's operating leverage. Hotels, planes. It's when you have really high fixed costs, when you've got a platform. VC goals versus founders goals. This is something that I don't necessarily believe a lot of people understand or appreciate or respect. It's not that VCs are bad people. They're not at all. They're in business to make money. And there is a very specific way they make money. And VCs do not make money apples to apples if you, the founder, make money. That's a misnomer. In other words, you'd think that the VC wants to invest in you because if you make a lot of money, they'll make a lot of money. That's not actually really their primary goal. They have what's called limited partners. The founders, the VC's customer is somebody that's called a limited partner. The VCs are general partners. Those are the people that sit around the table and decide what to invest the money in. They're called GPs, general partners. And then there's limited partners, which are all the people that give the VC the money to invest. It's usually pension funds, high net worth individuals, whatever. So the venture capital firm, the general partners, has the limited partner customers, and the limited partner customers want to see a return on their money. They want to see and make as much money as they can, as fast as they can. So the VC's goal is to show a return, a maximum return to their limited partners. The fastest way a VC can achieve that goal is to get the startup from one round to the next. That's currently the way it is. So if I go to a venture capital firm, if Curiouser.ai goes to a venture capital firm and says, we've got a product, it's in the market, it's selling, people are buying it, we're making money on every product, people are paying more than it costs. We've got product market fit, we've got a great team. We believe with X dollars of capital, we can break even and become profitable in 7 months. That's not going to excite them. What's going to excite them is if we say to them, with X dollars, we will need more money in 6 months. So we'll go from seed to Series A to Series B to Series C, the various rounds. And by getting big fast and burning a lot of cash fast, we will need to raise a lot more money fast. But all that new money that comes in will pay the old money that was already in. And so the new money monetizes the old money. And by getting bigger faster, you show these huge returns on the books that the limited partners love. So specifically, a venture capital goal is to return as much money as they can to their limited partners as quickly as they can. And a founder's goal, usually, not always, usually is to build a long-term successful company, even if it takes time. Those can be contradictions. Let's liven it up here. I'm not sure what this has to do with accounting, but I'm sure we can be creative and find a way to make it work.
Whenever I'm about to do something, I think, would an idiot do that? And if they would, I do not do that thing. Dwight Schrute. The entire efficacy of this incredibly useful piece of information hinges upon your ability to pick the right idiot. I wish there was a foolproof way to spot idiots, but counterintuitively, some idiots are very smart. They can dazzle you with words and misdirection. They can get promoted above you at work. They can even be elected president. If you want to be successful in this world, you have to develop your own idiot detection system. As part of the responsibilities of being your commencement speaker, I'm going to share mine. Sure, I'm naturally suspicious of people who never saw the original Star Wars movies, and even more cautious of people who loved the prequels and the sequels. But I admit this is not a reliable idiot indicator. No, the best way to spot an idiot: look for the person who is cruel. Let me explain. When we see someone who doesn't look like us, or sound like us, or act like us, or love like us, or live like us, the first thought that crosses almost everyone's brain is rooted in either fear or judgment, or both. That's evolution. We survived as a species by being suspicious of things that we aren't familiar with. In order to be kind, we have to shut down that animal instinct and force our brain to travel a different pathway. Empathy and compassion are evolved states of being. They require the mental capacity to step past our most primal urges. This may be a surprising assessment because somewhere along the way in the last few years, our society has come to believe that weaponized cruelty is part of some well-thought-out master plan. Cruelty is seen by some as an adroit cudgel to gain power. Empathy and kindness are considered weak. Many important people look at the vulnerable only as rungs on a ladder to the top. I'm here to tell you that when someone's path through this world is marked with acts of cruelty, they have failed the first test of an advanced society. They never forced their animal brain to evolve past its first instinct. They never forged new mental pathways to overcome their own instinctual fears. And so, their thinking and problem solving will lack the imagination and creativity that the kindest people have in spades. Over my many years in politics and business, I have found one thing to be universally true: the kindest person in the room is often the smartest.
I love that. Okay. So, equity and dilution. So there can never be more than 100% of something, right? So a startup is the same way. There's only 100% of it that can be owned. It's actually the same with every company, including Apple. There's 100% ownership. But with a startup, let's go back to the beginning, that there's two of you, and you decide to start a company with somebody, and you go and you form a Delaware corporation, which is usually where people start. They usually incorporate in Delaware because it's friendly to companies. Wyoming and Nevada are also sometimes used, mostly Delaware. So you start a Delaware corporation, and you each decide that you're going to own half the company. Very simple. So you're the CEO, you own half, and your CTO, she owns half. And you decide you need to hire somebody, that you need another engineer. So how does that work? Well, let's say you want to give the engineer 10% of the company equity. Where's that equity going to come from? Well, 100% of that company is already owned by each of you. So it's got to come out of your shares. That's called dilution. So if I own 50% and you own 50%, and we want to bring on somebody and give them 10%, I have to give up 5%, and my partner has to give up 5%. So now I have 45%, she has 45%, and the person has 10%. We just got diluted 5%. Our stock is worth less than it was. And that continues to happen every time you either distribute equity to prospective team members or investors come in. But every single event dilutes the stock of the people who own the company. And that's as simple as it is. Now, there's something that I'm amazed people get fooled by this a lot, tricked. But a lot of times when you're fairly far along as a startup, you have a certain amount of shares outstanding. Every company has to decide how many shares it has outstanding, just like a public company has to have shares outstanding. So let's just say your company has 1 million shares of stock that can be available. And you own half the company and your partner owns half the company. So you have 500,000 of those shares and they have 500,000 of those shares. And somebody comes in and takes 10% and you just do the math. They get that percent of the shares of the stock. What happens is that as companies evolve and bring on new people, the new people often neglect to ask, what percent of the company do I own? They tend to get mesmerized by the number of shares or options they're granted. And that is really, really deceptive. Really deceptive. Because if you have 1 billion shares outstanding, let's say you have 100 million shares outstanding, and you give somebody 1 million shares, 100 million, that's 1%, right? But 1 million shares seems like a lot, but it's actually 1%. If there were only 10 shares outstanding, it'd be what, 100 times worth more. So whenever you're going to work for a startup, or whenever you're in discussions around percentages of equity around a startup, the number of shares, the number of options you have is actually not relevant to the financial value of that company you accrue. It's all based on the percentage. Okay? Cap table is simply a table. It's a chart. It's a spreadsheet that basically just records who owns what inside a company. They can get pretty complicated. And I can explain why. It's not simple as it seems. It's very complicated, or can get very complicated. But a cap table is sort of the Bible. Every company has one. Well, every startup has one. Every privately held company has one. Who owns what? What employees own what? What partners own what? And what investors own what? I may be going out of order, but let me just go out of order now. The way Silicon Valley startups work is you're granted options almost always. Founders get founder stock, but I think it's illegal to give founder stock to people after the company has just been started. Technically, it has to be options. And there's usually this thing called a cliff and a vesting schedule. So you get 100 shares of stock, 100 options on 100 share. We can talk about the options in a minute if you want. There's a strike price. They're in the money, they're out of the money. It's the same as a call option on Wall Street, selling puts, buying calls. It's essentially, it's the same thing. But just for the sake of this discussion, I want to talk about the cliff and the vesting schedule. So if I hire you at Curiouser and we're going to grant you 100 shares of stock, which is like, say, X% of the company, there'll be a vesting schedule. Usually it's 4 years in Silicon Valley companies, meaning you're not going to get 100 shares or 100 options all at once. You're going to get it in increments over a 4-year period of time. It's called a vesting schedule. So with $100, you get 100 shares, you get 25 shares over 4 years, 25, 25, 25, 25. But then there's this thing called a cliff, which is your vesting doesn't start for a certain period of time. So one is how long it takes your vesting to run, and the other is when does it actually start. The traditional Silicon Valley technology startup structure is you get a 1-year cliff and a 4-year vesting. It's typically the way it runs. So typically, if you're in a Silicon Valley startup, and a lot of them are the same way. They could be 5-year schedules, 3-year, but it's usually 1-year cliff, 4-year vesting. If I give you, so basically, I'm going to give you 100 shares, but you're not going to get any for the first year. That's the cliff. So if you leave, or I fire you the day before that year is up, you get nothing. That next day, you accrue 25%. And then it's month by month for the remaining 3 years of the remaining 75% of that 100% allocation. Okay? So 100 shares, you get nothing for the first year. The moment the first year is up, you get your first 25, let's say it's 400 shares, 400, it's easier. But you get 25% right after that first year is up. And then the remaining 75% accrue on a monthly basis over the remaining 3 years. And at the end of 4 years, you either own all the stock, it's yours, or you own the right to exercise the option on the stock. You have the right to exercise the option if that stock is valuable, if that option is valuable to you. When a company is raising capital, you have to figure out what the company is worth, right? Because if people are giving you money, they're buying your company. Even if they're buying a little of it, they're buying your company. That means there's got to be a price for your company. How do they price your company? Like Curiouser.ai right now, what are we worth? I don't know. So the way startups raise money now is they use something called a safe. It's a really cool thing that Y Combinator invented. I'm not a huge Y Combinator fan, but this is a really cool thing that they did. And the way a safe works is, so for example, with Curiouser, when I was by myself, it was just me and a PowerPoint 3 years ago. And I was trying to convince people to give me money. Give me money, give me money, give me money. And people were like hanging up on me and laughing at me. Which is the way it usually goes. Finally, somebody said, you know what? We believe in you, we'll invest. We're going to give you $40,000. I raised 400. Well, it's just under 400, but say 400. So, but how much stock will they get for that? 40,000. What is that worth? We don't know. So what you do is you put it into a safe. So I basically took $400,000. I put it in a bucket. And I went to each of those investors legally and said, you don't have shares. It won't convert to stock now because we don't know what that conversion price will be because we don't know what we're worth. You don't know what we're worth. So safes are structured usually on a discount to the first institutionally priced round. So basically, the way our safe was structured is there's $400,000 that was sitting in a bucket. It's long gone. Spent it a long time ago. But on our cap table are all those investors. But they have, by each one of those investors is a amount of money they invested. But that amount of money won't get converted to shares or percentages until we have our first, what would be called institutionally priced round, meaning our market price is set by an institutional investor or some form of sale. Meaning if Google comes and says, we love what you guys are doing, we want to give you $100 million for 30% of your company. We are now worth, the pre-money is 100 million, 30 to 300 million. So now we're technically 300, we're worth $300 million post money. And there's a certain number of shares. Those safe investors are able to convert at 25% discount in my particular safe. You can set the terms any way you want. We set it at 25%. So basically, the people who invested money in Curiouser have the option of converting their money into equity at 25% discount to the same price that the institutional investor is paying, right? So if you do the math, and when Google buys our stock, buys our company, it's priced at, say, $100 a share. Google pays $100 a share. Our safe investors would be able to buy that $100 share for $75 because they took a lot more risk, because the earlier you invest in something, the riskier it is. Right now, we're a lot less risky than we were 3 years ago. You're never riskier than you are in the beginning. And theoretically, the further along you go, the less risk there is, because you got a product, you've got customers, you've got a team, you've got stuff that you. So that's the way a safe works. And it's a really cool way. It used to be that you had to do right. It used to be that it was convertible debt, which is really complicated, and I could never understand it. But they invented the safe. It's really cool. So basically, everybody who invests, usually in pre-seed friends and family, gives you a certain amount of money, and then they have the right to buy your stock at a discount to the first institutionally priced round. That's how that works. I think you've all heard there's pre-seed, there's seed, there's Series A, there's B, there's C, there's D. They go up. I mean, I don't even know what OpenAI is. OpenAI might be on Series G. But theoretically, you keep raising money until you're making money, right? So it's usually pre-seed, which is usually friends and family. So I raised a pre-seed round, 400. The next round would be seed. We're actually crowdfunding. We launched today a crowdfunding campaign, which is technically a seed round. It'll also be a safe. And then potentially we'd have a Series A, B, C, however that goes. You heard these? Have you all heard these terms? Fixed cost, variable cost, contribution, profit. They mean something. They're important. Okay, so a fixed cost is the amount of money that you basically fixed. You owe it, right? So your fixed cost is usually your staff, your salary, your rent, potential equipment, whatever. So every company has a certain amount of fixed costs that they owe regularly. You got to pay that. The variable cost is the amount of costs associated with each product you sell. The contribution is the difference between the price and the variable cost. So, break this down. If I have $100 a month of fixed costs that I have to pay $100 every month to keep the lights on, to pay the team, and so forth. Rent. Okay, $100. but every product costs me $50 to sell because it's $50 of parts in it or software or something in it. Meaning that the more I sell, the more it costs. Every product costs a variable cost. So I have to price that product higher than the variable cost. So if I have $100 of fixed cost and my variable cost is $25, and I charge $50 for my product, that's great. That means the product costs me $25. You're giving me $50. I keep $25 of contribution that I can then pay my fixed cost off of, right? And then you get to a break even, right? So if I'm, so if I'm making $25 on every product and I have $100 fixed cost, if I sell 4 products, I break even on my fixed cost. Believe it or not, a lot of companies right now that you're looking at, particularly in the generative AI space, have negative variable costs, which is what's so crazy. So Anthropic, OpenAI, Perplexity, all of them charge, either they give their product away for free, meaning they lose money on every product, or they pay, or you pay, and they still lose money. I did some math. I posted about this the other. So only 3%, closer to 2%, but say 2 to 3% of all the people who use GPT pay, literally. Roughly 2 out of every 100 people pay for that product, which is unbelievable. And the 2 people that pay, they still lose money on those people, because the price at $20 is less than the actual variable cost that it costs them to give it to you, to sell it to you. Meaning the more they sell, the more they lose. By my math, they'd have to charge $1,000 to $1,500 per user to make money right now, to cover a contribution to pay their fixed cost. So fixed cost is the cost that you pay to keep the lights on, salary, rent. It's the same pretty much every month. Variable cost is the amount of money associated with each product you sell. So think about it as, if you sell a flashlight and batteries are included, you have a flashlight factory that costs you $100. So you have to pay $100 for the flashlight factory, but you include batteries, and batteries cost $20 for every flashlight. That means every flashlight you sell, you have to basically incur a $20 cost for the batteries that are in that flashlight. So if you don't charge more than that, you're not going to make any money. You're going to lose money per volume. It's the same with software. It's the same with any business, essentially. CAC. Ever hear of CAC? People love to say, people love to go, so what's your CAC? What's your LTV? Just throw that terminology around. People think you're smart. The CAC is just a client acquisition cost. It's what's it cost you to get a customer. Curator.ai's CAC is 0 right now. We're not paying for customers. We're still relying on word of mouth, organic. We're not buying customer share like most companies buy. Marketing costs, advertising costs, promotion, discounts. So CAC is what's it cost you to acquire a customer. And the lifetime value is what's that customer worth. So there's math here, right? So if it costs you more to get a customer than that customer's worth, it's not a good business. It's a stupid business because you're not making money. If it costs you less to get a customer than the value that customer brings you, then it's a good business. And obviously, the less it costs you for a customer and the more that customer is worth, the better the business. right? So if a customer costs you nothing and provides infinite value, you own the world. If the customer costs you a lot and you get nothing, that's dumb. So lifetime value is usually a calculation that is done based on the value that customer brings to you over the lifetime of that relationship. So if it's a subscription and they pay $100 a year, and on average you lose a certain percentage of customers over 2 or 3 years, which is retention. You basically do the math and you say it costs us $10 to acquire a customer, and our customer is worth $100 lifetime value. The average customer stays with us a year and a half, whatever that is. It's a good business. The rule of thumb is you want to pay, your CAC should be 20% of your LTV. That's rule of thumb. So if your customer has a lifetime value of $100, you don't want to pay more than $20 to acquire that customer. That's kind of how that works. Obviously, the lower your CAC and the higher your LTV, the better. Margins are the amount of money that you make per product. Revenue time minus cost of goods sold. Retention, churn, how many customers do you lose, right? How many customers do you lose? It costs you a certain amount for a customer. They pay you a certain amount while they're with you, and then they leave. Obviously, you want to keep them as long as you can, but there's going to be some kind of a churn usually over time. So retention is when they repeat, when they pay a subscription on, or they buy more product from you, and so forth. There's different ways to raise capital. There's friends and family. There's angel investors. These are usually wealthy individuals. There's venture capital. These are institutional investors. There's family offices. These are very wealthy families that invest. Similar to venture capital, but there's differences. There's crowdfunding, Start Engine, WeFunder. There's strategics, companies that are strategic, like the Microsofts, the Googles, that may invest in you because they see advantages and you get advantages. You can get potentially grants. And the other source of capital that people forget is revenue, right? Revenue is a source of capital. So we raise friends and family, and we have some angel interest at Curious here. We have some potential VC interest, potentially family office, but we're gonna try crowdfunding. That's an experiment that we're gonna try. But these are all different sources of capital. I think we explained this. Limited partners are the people that give the general partners with venture capital firm the money. We're running out of time here. Always have to have a Steve Jobs video.
Would be the single most valuable piece of advice you'd give us to even attempt to create some of the value that you guys have done? And
you have to have a lot of passion for what you're doing, and it's totally true. And the reason is because it's so hard that if you don't, any rational person would give up. It's really hard, and you have to do it over a sustained period of time. So if you don't love it, if you're not having fun doing it, you don't really love it, you're going to give up. And that's what happens to most people, actually. If you really look at the ones that ended up, being successful, unquote, in the eyes of society, and the ones that didn't, oftentimes it's the ones that are successful loved what they did so they could persevere, when it got really tough. And the ones that didn't love it quit. because they're sane, right? Who would want to put up with this stuff if you don't love it? So it's a lot of hard work, and it's a lot of worrying constantly. If you don't love it, you're going to fail. So you got to love it. You got to have passion.
That is the secret ingredient. You know, on a personal note, I've got a lot of experience and I've done a bunch of stuff, but starting companies, no matter how experienced you are, is really, really difficult. And it can be very lonely and be very painful. And there's a lot of challenges you have to put up with, a lot of setbacks. And you literally want to quit all the time because there's easier ways to live your life. And that is the key, I think. And people say it and it's a cliche, but that really is the key. If you don't quit, you will succeed, right? If you last long enough, you will figure out a way to succeed. And that is the conclusion of the presentation. I threw a lot at you. Probably too much. I hope I explained some of it. I hope some of it sticks. It's all language. It's all it is. It's all vocabulary. Literally, all businesses is like learning French. It's like learning Spanish. All it is. It's just a language. When you walk into an investor meeting and you know the language, and they know you know the language, you walk into a board meeting, you talk to a CEO, it gives you stature. It gives you a level playing field. If you don't know the language that they speak, you're at a disadvantage in a major, major way. And so I would highly, highly suggest that anybody interested in being part of a business or starting a business take the time to understand the fundamentals of business, which is primarily accounting and finance. Questions? Easy questions. Hard questions. Andrew, no questions from you. You're going to ask hard questions.
Typical.
Because you're a physicist.
Failed.
No, there's no such thing as a failed physicist.
I thought Eric would have
apologize for not being on the camera, but there are a couple of questions that are in the chat. Should I read them out?
Can you sing? Can you sing them?
To make up for the lack of my face.
Yeah, Mary, why don't you sing the questions?
I mean, I'm sure we can make a really good song with all these words. Okay, this one's from Tim. And Tim says, how much time, effort needs to go into gauging market for demand, determining CAC, LTV, etc. So just what is the time and effort to just get it right?
I don't know if there's an answer to that question. There's this thing called founder market fit versus product market fit, which is what I think a lot of startups have, which is that the founder is basically building a product that they themselves would want, right? So I was an entrepreneur most of my career, and I struggled with how to tell my story. I struggled with the creative component to branding. I struggled with the way to talk to customers, acquire customers. I struggled with how do I put together pitch decks. And I thought to myself, wouldn't it be amazing to have a product that would help me do that? And that was really the essential genesis of Alice, was initially a generative AI product designed specifically to help entrepreneurs and creators build their narratives in order to achieve whatever those goals are, product market fit, product raise, and so forth. So my inherent product market fit sort of was baked into what it was I was doing, right? Because if the product was going to help me, then the product would probably help other people like me. I didn't know what it would cost to sell this product, because you just don't know, right? Because there's this, because our product, for example, is built on foundational models, large language models that are produced by other companies, right? So right now we're basically sitting on top of primarily Claude. We were GPT. We still are, I think, a little GPT. I think eventually it'll be Gemini. Eventually it'll probably be open source so that we can save money on variable costs and charge less and make more. But so I didn't know what my variable cost would be, which means I didn't know what our price would be. So we just I didn't know what the usage would be. So like, in other words, I have a product and I throw it out there. I don't know how much people are going to use it. I don't even know, right? How do I know? And if they use it too much, I lose money. If they don't use it enough, well, it's not. And so you just sort of figure it out. It's taken years to figure this out. And we determined that we needed to charge $5 for a 2-week trial, because that's roughly what we break even at, given our underlying variable costs, which is tokens to OpenAI or Anthropic or Gemini, whatever. And then we decided to charge $25 a month versus 20, because that gave us a little bit of margin that if people were heavy users, we wouldn't lose money. We couldn't lose money. We didn't have money to lose. We weren't like OpenAI. We didn't have money to burn. We just don't have that luxury. We're like old school. We're like the actual business that needs to function. So I guess the answer to your question is there really is no answer. It's as much art as it is science. Could we charge $50 a month? I don't know. Maybe. Do we want to? No. Do we want to charge a low enough amount that it's accessible to as many people as possible, but a high enough amount that we make enough money to keep going? And that all depends on your variable cost and on your price, who your market is, and so forth. But in terms of our CAC and LTV, we don't have a CAC because we're not paying for customers. And we don't really know our lifetime value yet because we're new, right? We're only a few months into it. We know that there's churn. We've learned that there's churn. We learned that our conversion rates are extraordinary at 60%. But we're losing people over time. And we think that that's a product issue. So we're learning, right? So we're going to figure stuff out as we go. So if I had to answer your question in the shortest way possible, I'd say it takes a lifetime. It takes as much time as you've got to get it right. And then you never do get it right. Hopefully you get it right enough that you can live to fight another day. How's that for a terrible answer? Mary, are you going to sing the next one?
The next question is, well, Lisa is thanking you for helping, fill in the VC language gap. And I think it's important, right? And I think that is connected to Tim's question as well. I think depends on like how much experience you have. Like, how many times have you done it before? Do you understand that industry, that market? Do you have people on your team who understand that? Because do you have tools like Alice, that's a plug, that help you um, really like hone into that, right? So I think it is also a huge part of that is experience. And um, a lot of getting some of this right or going or to an acceptable place is first making sure you have like either the people that have the experience or you have a good enough understanding of how all this works before you even start the process. Because if you're learning along the way, it's just going to take that much longer, right? So, and some of all these classes we're doing is for that reason, is that okay, we think that, you know, the tools are not enough, the words are not enough, the frameworks are not enough. You kind of need to have the team, the experience, the upskilling before you can even embark on like a more straight line path, or you can meander around it as well. You ultimately get there both ways. But Lisa's thanking you for helping. We appreciate you, Stephen. The rest, I mean, it was an active
Thank you.
chat group. There was a lot of conversation, but
I
not
wish I
really
could, I wish I
questions.
could see those. Yeah, I don't, just so you all know, I don't see that chat. I'm sure there's a way I could probably see it, but just so you know, I'm not ignoring anybody. I just don't see it.
So if anybody wants to just react, please feel free. But this was helpful. Stephen, thank you.
Yeah, Stephen, one thing about the VC thing, I didn't fully understand because I've never been involved with venture capitalists. So the sort of motivator of, you know, more rounds, right? So the first thing I thought of was Ponzi scheme because anybody can burn cash, right? So I can burn a lot of cash, give me money, and they'll be like, oh, sure.
Eric, it is they all are controlled Ponzi schemes. They really are. Ponzi schemes are not against the law.
Yeah. So, you know, I guess what that leads to is a question about like what happens to a VC if, you know, a boatload of money is being poured into a company that turns out to be, you know, useless and worthless and ends up going out of business. What are there any consequences for that VC? I mean, I
No,
don't see that in history. I
no,
don't see that
there
at
aren't any
all.
concepts. There really
Yeah.
aren't. Like, think about it. Think about the companies that invested in OpenAI. OpenAI is a 10-year-old company.
Yeah.
Okay, most people don't realize it. It's been around a decade. So there were a lot of investors initially who put money into that company. And they kept trying to get it to be worth more and more and more and more and more and more. So more money would come in, Ponzi scheme. And then there were the secondary markets that were created and they could cash out. So lots and lots of like Reid Hoffman, Sequoia, Andreessen, they all made tens of millions of dollars on OpenAI already. They're long gone. Bye-bye. See you later. So if the whole thing blows up, their limited partners are perfectly fine. The person who's terribly unhappy is what's known as the last fool,
Yeah.
called the last fool theory, right? It's that idiot who shows up when the party's over but doesn't know it yet and pays a ridiculous amount of money to buy into a $500 billion valuation is what I think OpenAI is now saying it's worth, $500 billion. Which, by the way, they're losing $80 million a day between now and 2029, if you do the math. $80 million a day. $80 million a day. Let that sink in. So, no, there are no consequences. And the other thing is the way the VC model works, which is brilliant, is you just have to be right a couple of times, right? I mean, so what's the it's literally the only profession in the world you can get rich and be wrong 9 out of 10 times.
Yeah.
You don't need to be right every time. And they tend to basically invest in packs. And there's momentum, and they invest in categories because that narrative drives up value and it increases the percent probability. And also that if it's super successful and they make money for their limited partners, they can say, aren't we amazing? We got into those great deals. That's because we've got clout. We're amazing. And if the whole thing blows up, they can say, hey, look, I mean, we did what we could. We did the best we could. Look at all the other people that also got fooled. So there's safety in numbers, right? So that's kind of how the industry works. And it's not all bad. I mean, I don't really want to be overly judgmental or critical of venture capital because, I mean, it has fueled a lot of innovation in the world. I just think it's changed a lot. But that's because I'm old and bitter, angry. As you get old, you get bitter and become a curmudgeon. And there's something about a 12-year-old venture capital associate who just graduated from Wharton asking me what my barrier to entry is. It just makes me want to go get a gun and shoot somebody. But heck, what do I know? What's your barrier to entry? Who's your persona? Those are the two favorite questions. So there's no consequences usually. And keep in mind, the other thing is that when you achieve a certain level of reputation, you're in the deal flow. So if you're Sequoia, every deal on the planet Earth, every single thing on the planet Earth comes into you. You're like a funnel for all. You get to see all of it because everybody wants money from you. Y Combinator, similar, right? So you also have the inherent advantage structurally of being in the deal flow. You don't have to hunt for deals. They come to you. And you don't have to sell anybody. Everybody wants you because you've got the brand cachet. So the moment Sequoia decides to invest in you, everyone else will want to invest in you. They won't even do due diligence. That's the other thing. There's usually only one venture capital firm. They usually invest in groups because that way they can diversify the risk. It's very rare that one VC will invest and take an entire round. And one VC does the lead, and they're the ones who do the due diligence. They're the ones who check the backgrounds of the founders, look at the data room, look at the economics, do the audit, make sure that everything is legit and real. And then once that company says, green light, we're going, everyone just lines up like sheep and tries to just follow. That's how that works.
Really a pack mythology.
Yep. There's safety in numbers, which is why so few people do think differently. Because it's really vulnerable. You're really at risk. You're really out there. It's much, much easier to be in the middle of the crowd.
Speaking of thinking differently, I was pretty amazed that Microsoft, with their accessibility controller, was thinking differently. Especially for the Xbox 360. They changed the entire way that they made a product. And I thought it was pretty amazing. The one guy was saying that they made it too cheap. And because they made it too cheap, because they sold it only on Microsoft's website, they couldn't get stocked at Amazon, or government contracts couldn't buy their stuff. So they have to increase the price.
I read a post this morning by Connor Grennan about how Microsoft has invented this new light computing technology and I don't totally understand it. But I guess I wonder if there is some innovation going on at Microsoft.
I thought their accessibility people for people that are disabled or veterans, I thought that was pretty big innovation. I'm not saying, it's not hundreds of thousands, but for those thousands that are affected, that's world changing and game changing from a societal point of view.
Yeah. I'd love to see innovation come out of some of these larger companies. I really would. I mean, I don't care where it comes from.
Well, I mean, we saw innovation come out of like Xerox Park Place. I mean, that's what basically was the
That was Apple, Windows.
that was Windows and Mac.
Yep,
Because Xerox couldn't capitalize on it.
yep,
Or look at Unix. I mean, Unix
yep,
came to AT&T, and AT&T couldn't sell it, so they just gave it away for free to universities.
yep.
Hence BSD and LSD from Berkeley.
And PTSD.
Oh, true.
Just joking, just joking. But yeah. I don't know. It's really gonna. I just you all know that I spent a lot of time thinking about AI and the economy and jobs and Gen Z and where it's all going and what can we do about it and so forth. Um, and I guess what still really just blows me away is just how wrong I think the world has it.
No, I don't.
But we'll find out. We'll find out.
I don't know if the world has it wrong. I think some people have it right. I think a lot of it is just that I think we're still in the hype bubble. And I think when the hype bubble bursts, it's going to be pretty epic because Gab is really a mimicking AI. So it's effectively a really smart parrot. And you got to check it. And people just don't want to do the due diligence, is how I see it.
Yeah. Well, if it's anything like the internet, that will be good news because the internet really just got started after the crash. That's when it really became a business and value was inherently baked into a lot of the industry versus prior where it was just all the Ponzi schemes. It's sort of like every bubble is, it seems like every major disruption is got its Ponzi phase. And then it's got its, back to basics fundamentals phase.
Yeah.
Right? Kind of. You could look at it almost as AI 1.0 is Ponzi, AI 2.0 will be, I think, augmentation and value. We'll see. It'll be fascinating. Love it. Love it. We're so lucky. We're really lucky that we're here right now.
I mean, I just think that we live in interesting times. I mean, you look at some of the stuff that Missy Cummings is doing, especially with automobile safety and drones and stuff like that. The very fact that you can actually have a drone landing on an aircraft carrier is pretty amazing.
Yep. No, I love it. It'll be great. Really interesting times. Well, people, grateful that you're here. Honored. If anybody has any further questions, you know where to find us. And are there any other questions? Okay. Well, thank you to all of you. Thank you to my extraordinary and amazing colleagues who I worship and adore. And see you around the block. Be careful out there. Play nice. Be nice to people.